Forecast for October 27, 2021. Mean Reversion Trading Weekly Review. Summary. The fundamentals continue to be completely opposite of what gold and silver are doing. We have the most bullish fundamentals in recent history, Equity Management Academy Patrick MontesDeOca said. As we move in the fall, MontesDeOca said, we are likely to see another series of supply shortages. Fundamentals. We have the most bullish fundamentals in the history of these markets, Equity Management Academy CEO Patrick MontesDeOca said. Fundamentals including an economy damaged by the pandemic, supply chain issues, massive debt and printing of money, inflation, and devaluation of fiat currencies suggest that precious metals should be trading at far higher prices. Just compared to crude oil, gold and silver are undervalued. Crude oil is at $85 a barrel and commodity prices have exploded. As we move into the fall, MontesDeOca said, we are likely to see another series of supply shortages. We are looking at stagflation, which is affecting the price of just about everything across the board. In the face of all these fundamentals, why are gold and silver trading at their current levels? Gold and silver have traditionally been considered currency. Bitcoin is an excellent market to trade, but gold and silver will be around for the long term for certain. Bitcoin may not. Other cryptocurrencies may take over the mantle of Bitcoin. Nothing is going to replace gold and silver. Since the fundamentals are at odds with the precious metals markets, we rely on technical analysis as the basis for our trades. For silver, our variable changing price momentum indicator, VCPMI, recommends this week to exit shorts at 23.31 and 22.23, and then go long from these levels. You can also exit longs at 25.20 and go short from that level if activated. Silver is trading around the weekly average of 24.12. We wait for the market to reach an extreme above or below the mean to make the highest probability trades. The market almost reached the buy one level of 23.88 early this morning. It then reverted from 23.91 after finding buyers. We have seen and we have been saying that the seasonal loss is based on a September 28 to September 28 cycle. We appear to put a bottom in on September 29 at 17.21, which we recommended our subscribers go long from that level. The next day, gold reverted back above the previous 4 days highs. The target was the mean of 1790. Gold has reached the extreme above the mean again, the sell one level of 1819. And we have almost reached that level. We reached about 1815.50 on the 22nd, and that is almost a $100 move since September 28. Gold is activating a daily bearish price momentum. We are going to see choppy trading. Just below the weekly average is a daily buy signal of 1782. We may go down to 1764, but let's see what happens. We have a bearish price momentum on the daily within the larger bullish momentum overall for the longer term. We trade below a trend line of support for a short time and then moved back up right into the weekly average, which is where we are now. The path of least resistance is to buy corrections. If you get the opportunity into the 1782 and 1769, all the way down to 1734, MontesDeOca said, there are high probability areas to accumulate and add to your long position. If we get above 1790, the target of 1829 comes into play. For the monthly data, we hit a low in September, and now we are trading between the annual average of 1840 and the monthly average of 1772. This is the range in which we are trading right now. You want to buy into this market at the low end of this range if the market comes down to those levels. If we break above 1840, then we are looking at a target of 2002. We appear to be setting up for that to happen. And if it does, it will happen real fast, MontesDeOca said.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes.
Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. And I just shared with you a report that we published basically on Saturday, and I wanted to review essentially what has happened here today. And when we take a look at the charts here this morning, let's see. Let's take a look at the gold market here. And basically, what we have seen here is the confirmation of the seasonal low that was anticipated on the 28th, coming in basically on the 29th, confirmation, reverting right back up, activating a weekly buy signal from 1734, and basically, or the area of 1764 to 1734. Reverting right back up to the extreme above the obviously daily means on the left of the chart, or the targets daily we have just completed. Today's target of 1811. And if we take a look at the 15-minute bar, it'll give us a much closer picture in terms of the time frame. 5:30 a.m. a high was made of 1812.70. So as we came in today, the day targets were completed. This information is provided to subscribers only in our live trading room. And it is prospective information that you can apply as a GPS for your trading. It can guide your trading depending upon what you're doing, multiples, your profile for risk and money management. And what I'm sharing here for those that are serious traders that want to make a difference in terms of how you look at the market, this area between the sell 1 level and the sell 2 level are identified as distribution of supply, where there are probabilities, mathematical probabilities that are very high that you could experience supplies in this area. And what we saw here is the reversion to the to the mean being completed from the levels that we saw back on October 26 of 1883. You can see here the levels of 1778, 1788, they're all in this area of blue. And right below it, we have the weekly 1734. Well, what happened here is that the market ran up to make 1850 right into the distribution of supply area, or close to the weekly sell 1 target, and reverted. Now, for day trading purposes, what we do is we apply mean reversion trading. And basically, we look for the extremities in price, mathematically speaking, ideally, where the probabilities mathematically are very high in this area where you could experience supply coming into the market. So when you have this information ahead of time, as I said, it's like a GPS that warns you. It's a red light that warns you. When you get up here into this level, you want to apply strategies that essentially are based on your profile in terms of risk and money management, but there are several strategies that you can apply up here. For those interested, reach out to us, and we'll be more than glad to share with you what we do in our private trading room. In fact, we have a 2-week trial, and we are announcing basically we are going to be doing a live trading talk show at 7 o'clock in the morning Pacific Standard Time, and a recap on the close of the day. Live trading talk recap of what we did during the early show. And we're going to look at this situation very, very closely, because we are entering a period where we could see extreme volatility, as we are seeing right now. But any opportunity that we have to, or for the market basically to come down to these levels identified for us by the variable changing price momentum indicator, which is a very specific structure. It uses a maximum of 5 pivot points. Within those pivot points, we activate an algorithm that identifies the colors that gives us an idea in general of the what most conventional technical analysts would say support and resistance. We activate these levels into an algorithm that identifies high probability trades, when to get in, when to get out, what your target is, and also what your protective level is. So looking at just the market price action in relation to these levels, you can see that every time the market came down into this area, it reverted right back up, right to the extreme above the mean. Even from this trade here on October 21st at 1788, 1815. So if we take a look at the little bigger picture here, what I'm doing here is I am long the market. I've recommended my traders, my subscribers, to be long the market. We've published several reports in the Associated Press, Seeking Alpha, that we've been expecting a bottom once again, a seasonal bottom on September 28th. And that's exactly where we are in. Now, what we're looking for is for the demand that has unfolded here, which is stronger than the selling pressure that brought the market down, or sellers. When the market reverts after the target is completed, it's the strongest signal that we can identify using the variable changing price momentum indicator. So where are we going from here? Well, it looks like the market has entered a daily and bullish price momentum. The VCPMI basically is the velocity of price in the bigger trend. And the bigger trend, as you can see here, was essentially initiated back in 2018 with the law of 1196. We've been in this bull market since, with the exception of last year. The pandemic hit and it collapsed the market from a high of 1704 to a low of 1450.51. This was I would say probably an incredible opportunity if you missed the previous bull market. It gave you the opportunity to load up on gold again. As the pandemic unfolded, the price of gold rallied obviously more than $600, all the way up to $2,089, approximately, relatively speaking, to the contracts. And what we've seen here, and this is very important, is this correction that essentially was, I believe, an anomaly with such previous bullish fundamentals, with the tremendous amount of stimulus that was provided by the Feds in the history of these markets. It gave the financial markets the liquidity to be able to survive this crash that we saw. And with regards to the gold market, it rallied $600. Obviously, the stock market has more than doubled since. And what we saw basically during this crash was the transformation of the economy from a physical economy as we knew it to a digital economy. And the smart money obviously anticipated this, and we have seen now the stock market rally from 2174 all the way up to 4590. More than double. In the face of the economy collapsing, basically. Now, what we're seeing here, coming back to the gold market, is that this is the second leg, corrective leg, using wave counts. The first leg was the rally from 1196, 97 all the way to 2089. If we just take the low that we made last year of 1450, what we get here is the completion of a Fibonacci 61.8 correction. Golden ratio correction target, which confirmed the bottom was made and the reversion unfolded, bringing us back once again all the way up to this high that we saw on May 31st of 1919. Now, what this did is basically established the resistance of the uptrend that we had built. And if we just connect the uptrend channel support level, we got a pretty good idea the bottom of this channel was into that 1764 area, just using conventional technical analysis. The market came down right into that level and made a low of 1721 on September, or the week of September 27, as we anticipated the seasonal loss to be in place, to begin. And we looked for a bottom during this time, and we got the confirmation that we needed. So where do we go from here? Well, we're taking a look at the uptrend channel within the variable changing price momentum indicator that you see here, and we have a combination of different indicators here. We have cycles. This circular line here is the cycles, 30-day cycles that we look at. And within that frame, we include the Fibonacci retracement, we include Fibonacci fanned trend line resistance levels, and we incorporate the variable changing price momentum indicator that is telling us a few things. It's giving us a story that the market came down, made a bottom at 1721, right into the accumulation of supply that the VCPMI recommends for you as a trader to do. And when it activated this signal here, it also activated the targets above. In terms of the weekly targets, we're looking at a high of about 1819. So far, we saw 1815 and a half, and we have seen a high today of 1812.70. Okay, so what do we do from here? Well, this area is resistance. We have seen the market break through the resistance levels, the fan trend lines, and now it's entering into the resistance level and the last fan trend line, which brings us up to about 1823. So as the price, as the algorithm adjusts to the price, what this is saying here is that the weekly target for the rest of the week, we're looking at about 1819. The second target is 1845. Now, depending upon, again, the supply and demand, and it all depends upon the buying strength down here, the buyers down here, whether they are able, once again, to absorb the supply that's being implemented down here. If we break this resistance level, we're looking potentially at nothing above the market from this level here, clearly all the way up to 1919, and the upper end of the cycle is giving us the Fibonacci extension as well, connecting to that 161.8% Fibonacci extension target of 2042. So we're about to break this level of resistance here. And if we see this, again, 2042 is the target. Let me bring up TradeStation and watch the market here for a few minutes and see what's going on here.
Listen up, we are hiring. So if you are a salesperson, you're not making at least 15.
We have very strong digital currencies. It looks like Bitcoin has reverted back up about 4 or 5%. GBTC up 4.5%. GDLC up 6%. BT up 3.21%. One of the anomalies that we're looking at today is the fact that the silver market is not following through so far to the gold market. It's lagging the gold market. So it remains to be seen as the day progresses what happens here in the silver market. In the meantime, my friends, I think it's been pretty clear here to me, and I hope to you, that I made it very clear in terms of what the variable changing price momentum indicator is recommending. We'll talk to you soon. Have a great trading day. Be safe.